All right. So now we're going to look at a few of the checks that we can see in order to basically inspect if there are some sort of manipulations being done on the balance sheet. The first one to look at is capital work in progress to gross block, right? So a company can not always just buy assets, but it can also build particular assets in order to suit its production requirements, right? And till the time that asset is being built, it is recognized as capital work in progress. Now, the important thing to understand here is that on capital work in progress, no depreciation is charged. But as soon as it is transferred from capital WIP to asset, depreciation needs to be charged, right? So an unusually high amount of capital work in progress might indicate that the company is delaying classifying it to an asset so that it can save on the depreciation, and hence the profitability might be higher, right? So in order to check this, you might also want to look at what are the company's expansion plans, right? And see that what was the period during which the asset was supposed to be constructed, and has it been timely transferred to assets and appropriately reflected in depreciation, right? So you'd also figure out that there are a few checks that are working in tandem. For example, depreciation rates and this one also somehow works along with each other, and you can look at one and figure out, okay, there might be something wrong. The next one is contingent liabilities and commitments. Now, this is very, very important, right? So liabilities are basically the dues that the company has to pay to outsiders, right? And so that is one part. Now, few liabilities are very certain, right? Which are reported on the balance sheet. But with some liabilities, what really happens is that it might happen or it might not happen, which means that the company might be liable to pay it in future or might not be liable to pay it in the future. For example, any sort of legal disputes, right, that are there, or any sort of guarantees that the company has given, or warranty provisions, right? Now, because these are not certain, the company doesn't have to provide for it on the balance sheet, and but the company has to separately disclose it as part of the notes to accounts. So in the notes to accounts, you'd find a certain note which will disclose the contingent liabilities and commitments, and also the description of when these would become real or actual liabilities and be transferred to the balance sheet. So you can check these, you can add these up and calculate as percentage of equity, right? Because these would eventually lead to a payment and lead to an expense as well, which is going to impact the equity. Again, what you would want is this figure to be as low as possible. An increasing figure or even a significant amount of contingent liabilities and commitments might indicate that there are risks with related to the solvency of the company that are not really evident on the face of the balance sheet. So which is why this becomes extremely important. The next one is goodwill to equity, or you can calculate it as goodwill to assets as well. Now, when we talk generally, we think of goodwill differently, but in accounts, only the purchased goodwill is shown, right? Which basically means when one company acquires another company and it pays slightly more than its fair value, that difference is basically the goodwill, right? So goodwill is not really an asset by itself, right? So which is why it cannot be employed. A very high percentage of goodwill might mean that the company has done a lot of acquisitions, and goodwill in the future can become impaired, right? So any sort of downgrade in the cash generating ability of the assets would result to a reduction in goodwill as well, which would be passed through the profit and loss and lead to a decrease in the profit as well. So you would not want a very high percentage of goodwill. There are also other intangible assets such as patents or copyrights, but they have a defined life also, and they have a defined purpose. With goodwill, there is no such thing, which is why it becomes a gray area, and which we really need to inspect. Now, the next one is changes in reserves versus profit. So with the recent changes in accounting policies, what you would find out is that there is a section of other comprehensive income along with the profit and loss statement. What this basically includes are those transactions that are conducted directly through equity. So generally all the transactions pass through the profit and loss, and the net figure, which is the profit, that gets added to the equity portion of the company, and from that any dividends are paid out. But there are certain transactions that do not need to pass through the profit and loss, and those are treated directly in equity. And you do not want these number of transactions to be extremely large or the amount to be extremely material, right? Because if this figure is very large, this might indicate that the company is not taking that transaction through the profit and loss and just treating it directly through equity in order to boost the profitability or the earnings figure, right? So you can look at changes in reserves, right, which is basically the changes in value of equity versus the profit less dividends, because dividends are paid out, right? And if there is any sort of significant difference between these two figures, then you would need to check the items in OCI. Usually there are very limited items that can be treated directly through equity, but still it is very important that we take a look at all the transactions to see if there is nothing doubtful or nothing uncertain. All right. Now, with the balance sheet, the final one is yield on cash and cash equivalents. Now, cash is a very important part of business, right? It is called as the lifeblood of business. But companies can also manipulate this figure. Well, how? Because, so for example, they could just get the cash in their accounts just before the reporting date, which is the year end, and after that, they pay it back. So they might not really have cash, but they show that they have cash. And a way to check it is to look at the yield on investment. So companies don't maintain all the cash in their bank balances, right? They invest some bit of it in financial instruments, in safer financial instruments. So you can, and that are reported in the non-operating income. So you can take a look at the yield on those cash and cash equivalents and see that, okay, evaluate if they're earning a return that is as per the market rate. So you can look at that where have they invested their excess cash, and you can compare it with the yield that they are earning to evaluate if it's fair or not. All right. Now I'm also going to take a look at a certain other aspects with respect to the forensics checks. And these are also very important. The first one, as I talked about in an earlier video, is related to accounting policies. So if you find out there have been any material changes in accounting policy, it is very important that we understand the impact of those changes and the basis for basically changing in accounting policies, because accounting policies are not usually changed. So there has to be a definitive basis. There has to be some sort of reason, and that reason usually is that changes in accounting policy leads to better or fairer presentation, but we need to evaluate that. The next one is related party transactions. Now, related parties are basically you could a subsidiary company or a parent company or a sister company where the company and other company share a parent, or there could be other private concerns of directors or promoters, right? Or where key management personnel are common between various companies. And these are very, very important and very, very prone to manipulation, right? Because money can be taken out from the one company to other company using related party transactions. A lot of related party transactions are part of the natural course of business. That is completely all right. But a lot of related party transactions are actually the way that the promoters might take out money from that company and feed it to other companies, right? Or for their own concerns, right? Now there would be inflows and outflows. So do not net the amount, because if you net the amount, then obviously it gives you a smaller amount, and hence if you compare it to revenue, or if you compare the outstanding balance to assets or equity, it would be a lower percentage. Instead, just take the total value of transactions that are being conducted. And again, what you would want is this figure to stay consistent and low as possible. And you can also inspect that what are the nature of transactions. So for example, if the company is a subsidiary company of a parent company, and if it is having transactions with another subsidiary company or any sister company that is established overseas, so a lot of these might be normal part of the business, but be very careful about transactions that are done with private companies where the promoter is same, right? Or where the director is same or something like that, because those might be areas where money is being taken out of the company, and we need to be careful of that. The final one I will talk about is remuneration to key management personnel. This will also be disclosed as part of the related party transactions in the notes to accounts. And what you would want to look at is that the growth in the remuneration paid to key management personnel should be in line with the growth in revenue, the growth in earnings, right? So you do not want the key management personnel to be paid extremely high or exorbitant amounts of salaries and stock options when the company is doing poorly, right? There should be alignment between what is being paid to the directors and the key management personnel with how the company is performing. So that is again an important aspect to consider. Now, there are also several other corporate governance practices, and there are also a lot of softer aspects that we need to consider to evaluate how the company is being run and how much can we trust them, right? We look at some factors that affect corporate governance later on, but for now, these are the various forensic checks that I wanted to share. Now, I know that these were quite handful, but I hope that you're able to go through these and take a look at whether the company's accounts are reporting its performance fairly or not. So this was more or less it for forensic checks. You can feel free to add more checks, and please calculate these various metrics for a number of years so that you can compare. You can also compare with the industry average or the median or the industry leader to evaluate how good the company really is. And please do not take these forensic checks as absolute good or bad, but look them as a guidance in order to understand that which are the areas that require more inspection and if there are any sort of problems. So that is it for forensic checks. Next time around, we're going to look at the different financial statements and everything that we've done till now, comparative, common size, ratios as well, and take a look at that how can we frame the observations. All right.